Hello everyone. How is everybody doing today? We already have some people coming in. We have Bharpur Singh, Ravi Singh. Hello, Dheeraj. Hello, Sanket. Hello, good morning. Mansukh Patel. Good morning. We'll answer your question, Mansukh. So here we have Vivek Sharma. Vivek sir started his career about 20 years back from Oracle. Then he went on to become a derivatives trader. Then, after a couple of years, joined ST Group, and we are doing this webinar again with ST Group today over here. Vivek sir at ST Group headed the sales and marketing for ST's PMS and AIF department and products. After that, he became the founding. He founded. He became a part of the founding team at Gulaq. So we are here to do a webinar on factor investing. And yes, so I hand over the stage to Vivek sir now. Vivek sir, we can get started.
Thank you for having me here on Dan's YouTube channel. So what I'll do is in today I prepared a PPT in which we'll cover the evolution of factor investing because that is what we are doing. Factor investing is what we practice at ST and Gulaq, and that's how we construct our portfolio. So I'll just discuss the historical evolution of how factor investing came into being and how it is currently being practiced. And I'll talk a bit about how we are at ST use factor investing to construct these portfolios. I'll talk a bit about our portfolios also. So yeah, I'll start. Yeah, can you see my screen?
Yes, sir.
Okay. So first of all, the standard disclaimers. This is a presentation primarily for education purposes, and please don't treat anything that we discuss today as an advice to invest. And we are also will be discussing the past performance of few of these factor funds and also how we are doing. So past performance is definitely not indicative of what could happen in the future. And finally, the investments in securities market are subject to market risk. Please read all the related documents carefully before investing. Okay, so so just to explain factor investing, I'd like to start with a simple example. Let's say a student is taking an exam, let's say a competitive exam or engineering to become a doctor or maybe other exams like CA. Now, what happens? What drives a student's performance in the exam, right? So, exam score or his performance is actually a function of multiple things. One is his IQ. So, how strong his IQ is. Another thing is how much he has studied. So even though his IQ might be very good, but if he has not really studied well, then he won't be able to score well in exams. So second factor is how well he has studied. Then another is the exam temperament and things like that. It could also be, let's say, the guidance he got from his mentors, from his teachers. So all of these actually will determine how well he is scoring in his exams. Like, so when we can actually use all of these factors to build a model to predict how any student would do well in their exams. Now, factor investing is very, very similar. Now, in factor investing, what we assume is that any stock, there are multiple factors driving its performance. So it could be the overall market. So if the overall market is going up, any stock is much more likely to go up than go down. So one is obviously the broad market, but then there could be other factors like value, how undervalued a specific stock is as compared to its peers, as compared to the overall market, or how much in strong momentum that specific stock is. What's the size of the company? Whether it's a large cap, mid cap, or small cap, that also determines its returns, and also the quality of its fundamentals, the quality of the business, and many more things, right? So these are all the factors that we can use to determine how a stock would perform or might perform, right? So it actually started, factor investing actually started with CAPM, which was proposed by William Sharp in 1960s. And in 1960, what he actually proposed, opposite what was that CAPM, which is the capital asset pricing model, it identified the market factor, which was captured by beta of a stock as the primary driver of returns. So beta, let's say for a stock, so overall market beta is 1, and if a stock beta is more than 1, let's say if it is 1.2, what that means is that it is uh, more volatile than the stock market in overall. So if the market is going up by 10%, then the stock of beta having 1.2% will actually go up by 12%. And on the downside also, a stock having higher beta will go down much more than the market. So if the market tomorrow corrects by 10%, that stock is likely to correct by about 12%. So that is one example of beta. And the major criticism involved was obviously it's a very simple model, and it does not capture the real world properly. After that, in 1976, Stephen Ross proposed the arbitrage pricing theory, in which he said that there is not only one factor but multiple factors that could actually influence asset prices. Now, this was much more closer to the real world, in which what we see is there's not one factor but multiple factors that keep influencing at any point of time a stock returns. But it was more flexible, it was more realistic, but he did not give the exact specifics of what those multiple factors could be, right? So in 1992, that's when actually factor investing took off with the pharma French three-factor model. So earlier we had only one factor, which was the market or beta. They proposed pharma and French. These guys proposed two more factors, and these three factors, including, captured almost 90% of the returns that were being delivered by any portfolio. So these two additional factors were size as a factor and value as a factor. Now, size as a factor, what they suggested is that the smaller companies, now all things being equal, let's say for two stocks which have similar beta, but one is a smaller size stock, smaller size company rather, uh, and one is large size company. So smaller size company is likely to produce higher returns. So one factor was size, another factor was value, in which they proposed that high book to market value companies would produce higher returns as compared to the ones which have lower book to market value. So these are the two additional factors. And actually, in 1990s, after Pharma French proposed this three-factor model, the factor investing really took off. And after that, in 97, Carhart also proposed, and he added momentum as a factor, which is one of the most popular factors that we currently know of, right? So overall, across the years, what has happened in due to the advancements in computing power and also advancements in machine learning AI, this has led to tons of factors now getting created, which is able to explain the stock prices returns with much more certainty in a much better way, right? So currently there are obviously hundreds of factors. It depends on the fund manager also, that which specific factors they are using. But overall, multi-factor investing, which is also quite popularly known as quant investing, uh, it's a very good data-driven approach of investing. Just one second. Yeah. So first thing is, it's a very systematic and data-driven approach to investing. Secondly, the risk management actually could be managed very well. And finally, you can actually use dynamic factor weighting and really create the exposure that you really want to. If you really want to just take, let's say, exposure into undervalued small cap stocks, you can do it through these factor funds. Yeah. So let's now discuss some of the popular factors that are prevalent in the market that most of these funds are based on. Now, these are the top five factors. Obviously, there are many others, but these are the top five factors. One is value, in which what it seeks to capture is the excess returns to the stocks that have low prices relative to either its other sectoral stocks or overall market. And how this can be captured is by, let's say, price to earnings ratio, price to book ratio, or even price to sales ratio, which is not very popular, but it's quite powerful in itself. Another is size. So this is being captured by the market capitalization, and what this proposes is that the small cap stocks tend to generally perform better than the large cap stocks. Uh, Momentum, which is excess returns to the stocks with strong past performance, it is being captured by historical returns. Let's say past 6 month returns, if you just sort, and the stocks which have the highest returns in past 6 months are expected to perform better overall in the next few months as well. Low volatility, which is again quite interesting as a factor, and what it suggests is the stocks with which have low volatility as compared to other stocks. These stocks overall will tend to produce higher risk-adjusted returns, right? And finally, we have quality. The better quality stocks, it's not necessarily that they are undervalued, but they are better quality stocks, and these quality could be measured by, let's say, return on equity or its earnings stability, how or dividend growth stability. All of these, the multiple factors that you can use, or multiple parameters rather, that you can use to for each of these factors, right? Now, again, these factors typically, all the factors don't work all the time. So, in rising market, typically what happens is momentum, size, value are the factors that typically work well. In a slowdown, when we are seeing some downtrend, at that time, quality, low vol has tend to work well, and also in a recession. And in the recovery phase, again, what works well is value, momentum, and low size. So these are the factors that, and if you can actually switch, if you have a good mechanism to identify which part of the overall cycle you are currently in, and accordingly use that factor to select stock, that kind of methodology actually could work really well. And that's what we are using in ST as well. So if you see over the last few months, what in our models, what we have seen is earlier momentum along with volatility was given higher weightage, whereas currently it's mostly quality in the last 2 months or so. It's mostly quality that we believe uh, would produce better risk adjusted returns. Okay. And now, like stocks also, what happens is, let's say a stock has really gone up a lot, and it's not really backed by fundamentals. So what is more likely in that scenario is that stock is more likely to correct to or revert to its mean, right? Similar kind of thing happens in these factors performance also. So a factor what could happen is a factor, it has really run up, it has really given very high returns as compared to the historical averages. And what is more likely to happen is that specific factor is its performance is likely to return to its mean. And that's what you see in this chart also over the last 10 years or so. What you see is momentum obviously is one very good factor, but there are other factors, and this performance every year it keeps on rotating. So it's pretty hard to predict which specific factor is likely to do well. But in Gulaq, what we have tried to do is, that's what we have tried to do, that which specific factor is likely to work in the current market conditions, use that to select your stocks. And overall in the historic, if you see the historical performance of Gulaq multi-factor model, it has actually given much better returns than Nifty itself, obviously. But as compared to these single factor models, our multi-factor model has worked much better. So this has, in the last column, we have the CAGR across the last 10 years, and you can see it's clearly there is a difference, right? This is the performance, the live performance of Gulaq Gear 6 that is based on a multi-factor approach. Our multi-factor approach uses tons of factors. And I think what we are able to do well is, first of all, define these factors in a much better, sophisticated manner. And second value add that we are doing is uh, which factor are working well at what point of time, and accordingly give weightage to those factors only, right? So if you see, since our launch in June 2020, our CAGR is close to double that of a Nifty multi-cap index, right? And every single year in the last 5 years, we have been able to beat the market consistently. Uh, Having said that, there have been many months where we have underperformed. So typically what happens in this is, out of 12 months, roughly 7 to 8 months, the Gulaq Gear 6 tend to outperform the benchmark, but then there'll be definitely 4 to 5 months in the year when the model actually underperforms, right? But net, we have been able to produce very good alpha. But if you consider the risk side also, we are definitely, because it's a very concentrated portfolio, we wanted to offer it to people who have maybe about 25,000 rupees to start with, right? So because of its concentrated nature, we have been able to produce very good returns. And obviously, we are taking slightly higher risk as compared to the BSE 500 index. So our annualized risk is also slightly higher, and the max drawdown also slightly higher. So if you see in BSE 500, we have 10% drawdown, and these are the live last 5 years data. And in Gulaq, what we have seen is roughly 13% drawdown. But if you consider how well we are taking that risk, so we can use Sharp ratio to actually determine whether the risk that we are taking is getting compensated or not. So if you see the Sharp ratio of Gulaq Gear 6, it is 2.76 versus BSE, it's 1.9. So what this tells us is that even if we are taking higher risk, the risk is more than getting compensated uh, by the extra returns that we have been able to generate. So it's the right amount of risk, or the rather good quality risk that we are taking, which is being more than fairly compensated by the returns that we are producing. Yeah. These are the maximum drawdown numbers also. Yeah. So this is earlier the data that I shared. This was based on monthly data, whereas uh, this specific data is based on the daily return series, right? Uh, Guys, just give me a moment. I'll just get my charger. Yeah. So, because what we are doing in this is, on a monthly basis, we are determining the factors that are likely to work, and using that to construct our portfolio. There is a fair bit of churn in our portfolio. And this specific one shows the returns distribution, and how this churn is helping us is, if a stock is not working in terms of its performance, it's not giving the expected results, we are very fast to actually take an exit from that stock and sell it. Whereas if a stock is working, then we tend to hold it for much longer. The average holding period would typically be maybe about 3 months or so. But it is possible that a stock that we have selected, actually we exited within 1 month, or we keep holding it for even more than 6 months. But how this overall helps us is, if you see these distribution, the stocks, first thing to observe is, obviously there are much more number of stocks that has produced positive returns. Obviously there'll be few stocks which has produced negative returns. And more importantly, the stocks that are giving us positive returns, the average profit from those stocks is much higher than the average loss from the losing stocks. So this data is represented here in this table. See, these are the top 10 winners and losers of last year. And if you see, the average of top 10 winners is actually pretty high as compared to the losers. So this tells us that the risk management of this specific methodology is being done very well overall. Yeah, these are the maximum drawdowns from the back tests. So even the maximum drawdown, if we see from the back test, actually Gulaq Gear 6 is expected to have a lower drawdown as compared to multi-cap. What we have seen is in the live market, this is slightly higher, but the CAGR is also pretty high. So in the back test, the Nifty multi-cap is giving about 12% return, whereas, and this is across last 12 years or so, since 2012. So Nifty multi-cap has given about 12% returns, whereas Gulaq Gear 6 has given about 30% returns in the back tests. This is how the market cap allocation changes from month to month. So past couple of months, what we have seen is the mid cap allocation is about 65%, 65 to 70%. Next comes in large cap, which is having somewhere around 25%, and small cap is having currently about 10% or so. But this can actually keep on changing. So in that sense, it is a flexi cap fund. And what we have seen is when the markets are not really looking good, the way it reduces risk is it tends to shift allocation towards safer stocks, safer sectors, and typically which are more in large cap category, right? This is the sectoral allocation. So currently we are bullish on consumer staples, materials, IT, and industrials. This is what it is for last 2 months. Obviously, earlier we had allocation to other stocks also, but currently we have all the other sectors like financials, consumer discretionary, all of these sectors we have zero allocation as of now. Yeah. Finally, a lot of people ask that Gulaq Gear 6. So what does it mean? What does it have? So what we actually follow in ST is a gear-based methodology in which what we say is that these gears, each person's risk profile is different. The kind of risk that you can afford to take dependent on your financial situation and dependent on your overall risk appetite, you can afford to take different levels of risk, and that is what is getting reflected in these multiple portfolios. So Gulaq Gear 6 has 100% equity, and it is meant for someone with a very, very aggressive risk profile. If somebody is not comfortable with this kind of risk, he or she can consider the other gears like Gulaq Gear 5, which has slightly lower risk because it has 20% debt. So lower risk, but slightly lower expected returns as well. And if you still want to take lower risk, there's Gulaq Gear 4 and 3, which has 60% in Gear 4 equity. And in Gear 3, we have 40% equity and the rest in debt. So Gear 3 is meant for very conservative investors. So that's how we have divided our portfolios into multiple gears. Okay. So yeah, I think that's it from my side. I'm happy to take any questions on markets also in general, but on factor investing and on our products.
Hello, sir. Very insightful. We have one question from Kush Kumar Singh. Kush Kumar is asking, sir, do you have any automated tool or application which determines these factors and it will show the growth of the indication of any stock by measuring the last performance?
See, we do not have a tool which we can offer to outside investors because it's a piece of code that we have, right? And but that is essentially what we are doing, and that's the whole software that we have built is used to create these portfolios, right? So actually, if you believe in these in this specific approach, or if you want to allocate some part of your portfolio to these quant funds or factor funds, you can actually subscribe to our portfolios, in which you will get to know what all are the stocks getting selected, how we are selecting. We conduct these monthly seminars also, monthly webinars, sorry, for our subscribers. But we do not have any specific tool that we can actually offer it to outside investors. It's not built that way. Yeah.
Understood.
And what was the second part of the question? Was there any second part of the question?
No, the second part of the question was it will show the growth or the indication of any stock.
Yeah. So what we can obviously what you can do is we keep writing a lot on Gulaq.com blog. So we have written quite a few articles on factor investing also, but also about our methodology and deep dive into its performance, live performance also, and the historical backtests also. So that is one thing. Maybe if you are interested to know more, that is one thing I'll encourage you to check out. Yeah. It's very hard to build a tool, obviously it's hard to build a tool, but it's not the tool or the methodology is very, very complex that it cannot really be made into a product and offer it to investors, to retail investors, so that they can understand very easily. That is one of the challenge that we are facing. So obviously the result of that methodology or the tool obviously is being shared in this portfolio. Yeah, but tool we do not have.
Understood. We have another question from Chaitanya. Chaitanya
Yeah,
wants to know how to know which sector is in buzz and which sector is losing its momentum.
yeah. Again, Chaitanya, I think it's very, very hard to know, because the way I showed, one sec, I'll just quickly share. Yeah. So you can see my screen, right?
Yes.
So see, like this, what I have done is in this presents which all factors have worked in the past, but similar sector rotation happens year to year basis. So some year it's maybe IT, another year it could be health care, or it could be consumer discretionary. So this trends, these themes keep on changing quite often, very often, right? So it's actually, I think, for a retail investor, I believe it's very hard to keep a track of what is happening and what could happen in the future. Uh, but what we have done in our portfolios is, in the back end, that's what we are doing, right? In the back end, we are using almost 100 plus factors, which is a combination of global macro factors, your fundamentals, and your technicals. So it takes a look, it takes a 360-degree look on each stock and each factor, and then determines what we want to select in our portfolio. Now, if somebody were to ask me how I can do it on my own, uh, it's very hard for me to answer, because see, what we have built is almost 15 to 20 researchers have been working on these models for now 5 plus years. Now, for a retail investor to to uh, to devote that much of time, build skill set, get that kind of data, it's almost impossible for an individual trader, right? Obviously, there's other style of trading which is more discretionary in nature, in which you study the sectors, uh, which is more the traditional way of investing. So there, maybe if somebody wants, they can spend time on it. But this specific quant-based approach is it's quite hard for individuals to practice, right? So I would not really suggest anyone to get into individual stock picking. Also, the data. If you look at the data, what we know is most of the investors that do stock picking on their own tend to lose money, right? So my suggestion is always that if you believe in stock picking, figure out a good fund manager. It could be fund manager like us, or it could be a mutual fund manager. Figure out a good fund manager whom you believe in, whose methodology you believe in, and invest with him. They'll charge a small fees, but I think that is worthwhile. Or if you do not believe in individual stock picking, then there is passive way of investing, which is you just invest in index funds, and even that is a pretty good approach to go ahead with, right? But to pick stocks on your own is something that I usually never recommend.
Understood. So, sir, the next question is actually not from our viewers. It's one of my personal questions as well.
Yeah.
Uh, Question is, we obviously conducted this webinar on the evolution of factor investing. I want to understand from you, where do you see the trend going in the coming 5 to 10 years? Do you see any new emerging trends in factor investing as well?
See, what I see is, I think in terms of growth, what is going to happen now is uh, currently, I think more than 95% of the funds are being managed by the traditional approach, right? What I see is going ahead over the next 5 years, maybe or so, in 5 years' time, maybe we might not have 50-50, but still a big chunk of funds is going to shift to these quant-based strategies. So currently, I think the investors, the fund managers who have experience would do well. But in the 5 years time, I'm going to see lot many new managers come up and do well in the quant side, and the overall shift, the shift from the traditional style of investing to this style. I cannot say in 5 years, but definitely in 10 years, I see that a majority of the funds would be managed through these quantitative strategies rather than the traditional approach. I think traditional approach will still be there, but it will be less than 50% of the funds would be managed in 10 years time, and majority of the funds would be managed by these kind of systematic quant based strategies. That is what I believe.
Understood. Sir, I think that's all questions that we have right now. It was a very insightful session, sir. It was very good to have you on our channel, to have ST collaborate with us on this webinar. I think we'll end the session over here. Guys, also, if you have any other questions for Vivek sir, for ST, if you want to know anything about the schemes as well, I urge you to comment it down below. If you have any other topics you would like Vivek sir or the ST team to conduct webinars on, then please also comment that down below. We'll definitely arrange it for you. That's it from our side. We'll end now.
And if anyone wants to know, obviously, we write a lot of blogs to educate our investors and the investing community. So people can go to gulaq.com, gulaq.com, and in the blog section, you can actually check out all the blogs that we have written about investing also, but about factor investing in specific also.
Perfect. I will also comment the link to the blog in the comment section below, so it's just very easy for every one of you. Okay, guys. Thank you so much. We'll end the session here. Thank you.
Okay, thank you. Thanks a lot.